All right, Mike, thank you so much for that. We want to delve into that subject matter a little bit more. So the question here, how much pain should Americans brace for? I want to bring in Bankrate.com's Chief Financial Analyst, Greg McBride, into this conversation. Thank you so much for taking time to talk with us today.
Great to be with you. Thanks for having me.
You know, this is one of those subjects that makes people a little uncomfortable, especially when you're talking about rate hikes and money and people possibly losing money. The Federal Reserve opens its two-day meeting tomorrow. What are you expecting to come out of that?
We will get another big rate hike, 0.75 of a percentage point. It'll be the third meeting in a row that they've done that, and it will bring those benchmark interest rates back to a level that we have not seen since 2008.
Yeah, that's definitely not what people want to hear. But do you feel that fears of a recession are feeding into that, into the Fed's decision-making process? And what kind of impact could that have on Wall Street moving forward?
Well, investors, and Wall Street in particular, seem to think that the fears of recession will cause the Fed to stop raising rates or eventually start cutting interest rates pretty soon. And the Fed has been pushing back on that notion, really saying in no uncertain terms, our job is to get inflation under control. We're going to continue to raise interest rates until we feel that it is, and we're going to keep rates high even once we've stopped. So there's the old adage, don't fight the Fed. A lot of markets have been fighting the Fed, and the Fed has been punching back.
Greg, let's talk about the average household, right? Because obviously these rate hike impacts families. It impacts their budgets. How do you think this particular hike will impact families overall?
The cumulative effect of this is really starting to grow. With a 0.75 percentage point rate hike this week, that brings the total to 3 full percentage points, and that's just in the last 6 months. They're not done. There's more to come. So the cumulative effect is growing, and where you see this, we've seen mortgage rates jump 3 full percentage points since the beginning of the year. That's definitely slowed the housing market. Mortgage applications are at a 20-year low. But households with variable rate debt, home equity lines of credit, and credit cards, those rates are moving higher in lockstep with the Fed. So a cumulative move of 3 percentage points in the last 6 months, that means the rate on your credit card or your home equity line is also 3 percentage points higher than where it was at the beginning of the year.
Staying right there and talking about that credit card amount and the rate there, a lot of people have credit card debt right now. They may want to pay that debt down because of these interest rates. What advice do you have for them?
Yeah, absolutely prioritize getting that debt paid down and paid off as soon as possible. Something that can be a nice tailwind. Grab one of those 0% or other low rate balance transfer offers. Some of these are good for as long as 21 months. And what that does is that not only insulates you from the rate hikes we're seeing now, but it gives you a runway where you can get that debt paid off once and for all. That's the end game, getting credit card debt paid off.
Absolutely, that is the end game, and hopefully this will have an end in sight soon enough for all of us. Okay, Greg McBride, Bankrate.com's Chief Financial Analyst. We appreciate you joining us today on First at 4. Thank you for your expertise.